Good morning, afternoon, or evening, depending on where you're dialing in from. And thank you very much for joining this session. Today, we're going to focus on the outlook for the real estate market in the face of the more challenging macroeconomic environment. My name's Simon Rubinsohn, and I'm the Chief Economist at RICS. And I'm joined by an esteemed panel who I will briefly introduce. Let me just run through the individuals very quickly, and then we'll move on with the actual discussion. First of all, I have Alexandra Innes. She has a background in banking and investment management, and she's now a board member of Knight Frank, a committee member at the Bank of England, and a non-executive director at Schroders Real Estate Investment Trust. She's a fellow of Chapter Zero and a member of the UK Green Building Council Leaders Network. The second panelist is Megan Walters, and Megan is Global Head of Research at Allianz Real Estate. And prior to joining Allianz, she led a team of 170 researchers at JLL as Head of Research Asia Pacific. She was also she was a member of the Leadership Board. She's a fellow of the Royal Institution of Chartered Surveyors and serves as a Global Governing Trustee of ULI. The third member of the panel is Louise Kavanagh. Louise is the Chief Investment Officer and Head of Asia Pacific for Nuveen Real Estate Business, having joined the firm in 2017 from Invesco Real Estate. She's also a global governing trustee for ULI. She's a committee member of LEAD, a Nuveen industry affinity organisation, which is leading the dialogue on gender diversity. So those are our three panelists. Before we have the panel discussion, I'm also joined today by a senior economist in the economics team here at RICS, Tarrant Parsons. And he's going to give us a brief sort of macro overview as it pertains to real estate. And that will, I think, help sort of set the scene for the discussion. So let me first of all hand over to Tarrant.
Thank you, Simon, and hello to everyone joining the webinar today. Just before we get into the panelist discussion, I want to provide a bit of background context, really, by taking a look at a very headline level of what may be in store for the global economy over the year ahead, as well as touching on some of the kind of key themes across commercial real estate markets specifically. Of course, I would add that forecasts, but for some variables at least, made in this current climate probably come with an even larger margin for error than usual. A lot of what unfolds will depend on factors that are very difficult to predict. But these projections that I'll share with you, they at least represent good logical thinking at this stage, and I think provide a very reasonable starting point when it comes to assessing the outlook for the year ahead. So to begin with, displayed here are some projections for the global economy. So these particular numbers have been produced by Oxford Economics, but they are broadly in line with what seems to be the average or the consensus view for the year ahead. And what it shows is that the global economy is forecast to fall into recession from Q1 of this year, lasting up until Q3. I would add that the definition of a recession when looking at the global economy is a little bit different than if you were looking at an individual national economy. At the global level, it's 2 consecutive quarters of falling output per capita, so per person, that is classed as a recession, even if the total level of output, so not taking into account changes in population, were to still be rising. So a little bit of a difference there. But as you can see, GDP per capita is expected to fall as we progress through this year, although it's a relatively shallow recession. So in annual terms, in fact, the growth rate projected throughout 2023 as a whole is broadly flat, with the return to growth in Q4 more or less offsetting the slight fall in each of the 3 quarters prior. So to put that into some context, global GDP on this basis fell by just over 2.5% in 2009 during the global financial crisis, of course, and by over 4% in 2020 due to the pandemic. So drop in output currently expected. As I say, it's much flatter, much shallower than both of those periods, certainly, but still the global economy is clearly losing momentum. High-income nations, so most nations within the G7, are forecast to fall into outright recessions this year, or come very close to that threshold, and that is going to present businesses in many instances with a more challenging, a more difficult environment within which to operate compared with last year. Can we move on to the next slide, please? So, of course, inflation is one of the more significant factors weighing on the outlook. I'm sure we've all firsthand experienced some sort of a substantial increase in costs or bills of late. But in aggregate terms, really kind of rapid growth in consumer prices is eating into disposable incomes, and this pinch or squeeze on spending power is a channel exerting real downward pressure on the outlook. So if we take a look now at what is forecast to happen to inflation from this point forward, well, the good news is that the annual rate of consumer price growth does appear to have peaked now. So that's thought to be the case both at the global level, but also within the United States, the Eurozone, and the UK. So the global average for inflation, it reached a little while ago close to 8.5%, and that was a similar pace to what was found in the United States. In Europe and in the UK, we've had a double-digit pace of price inflation, with the energy crisis hitting a little harder. But from this point forward, all of those lines depicting future CPI rates are on a downward trajectory. There's also been more encouraging news in terms of energy prices, so future gas prices. They have come down in recent weeks. So that's more encouraging. The bad news, however, is that even though all of this is easing now, inflation is still expected to remain well above central banks' targets in many instances throughout the duration of 2023. In fact, come the end of this year, headline inflation rates are still envisaged to be above or close to 4% in the UK and the United States. So this means that not only has there been almost a step change higher in prices, a dramatic shift upwards last year, but they're still going to be rising at a fast pace by historical standards over the next 12 months, despite base effects and things like that. And so that will continue to exert a significant kind of drag on household finances. It's not until 2024 that inflation is anticipated to drop back to close to the 2% target in the UK and the United States, although it is expected to cool to that pace a little sooner in the euro area. Moving on to the next slide, please. So with inflation still expected to remain quite some way above policy targets in the immediate future, it is thought likely that this will prompt some further monetary policy tightening from several of the world's largest central banks. So if you look back over the past year, many kind of central banks across the globe have not only implemented several rate hikes, but have also become more aggressive in the pace of monetary policy tightening as the year wore on. There are a few exceptions. China, Japan, for instance, would be examples where rates have either remained unchanged or been lowered. But in the vast majority of cases, interest rates have risen and risen quite significantly over the past 12 months. Now, there are a lot of different opinions on what level interest rates will peak at in this current cycle, especially across these areas that I've selected for the chart here. Again, as a basis for discussion, I've shown forecasts which are quite closely aligned with what appears to be the average view right now, although of course some sources will see the outlook slightly different. But I think the main point to make is that for each of these central banks, it does look as if there'll be at least some further increases in interest rates. If we take the UK, for example, the current policy rate, bank rate, sits at 3.5%, and this is expected to be raised to 4% potentially at the next meeting. I think maybe financial markets could still be pricing in perhaps one more increase after that. But these forecasts then point to policy tightening being paused after that next move. And a similar story can also be mapped out for the Fed, the Federal Reserve, and the European Central Bank, in terms of still maybe one or two further rate hikes expected to come, but then a pausing in that. I also think alongside that, though, it's important to note that as far as economic activity is concerned, the full impact of rate hikes that have come in the recent past is still yet to fully filter through or come through in its entirety. So just one example, of course, would be anyone with a mortgage that's fixed term is coming to an end at some point over the next 12 months. They are going to face a significant increase in their debt reservicing costs that up until now they've been insulated from. So that's one example there. But higher borrowing costs are going to be another factor weighing on economic activity over the coming 12 months, not only due to the scope for potentially a few more rate hikes going forward, but also on account of the time taken for previous tightening to fully filter through. So that all means that 2023 is set to be a tough year for the global economy. Inflation and high interest rates still the most significant headwinds, and as it stands, as I said, these forces are expected to tip the global economy into recession. Kind of more immediately, though, kind of already seen in the latter stages of last year, there has been a more direct impact from higher interest rates coming through with respect to trends in all property markets, really. But I just want to focus on what's been seen in the commercial real estate markets for the last section of my talk. So could we move on to the next slide, please? So yeah, one of the most striking developments across commercial property markets of late, I would say, it's very prominent in the RSS survey data over the past couple of quarters, and there has been a fall in capital value expectations, and then this has been also visible in the valuation indices produced by MSCI and CBRE, and these have fallen back quite considerably over the past 3 months or so. So I've plotted the survey data on capital value expectations at the global level on the graph, and I should say the final data point there is a provisional reading from our Q4 survey. So that's due to be released in a week or so's time. So the final numbers may be marginally different, but I would say this provides a pretty good steer on what we've received back in Q4. So as you can see, the fall in near-term capital value expectations across all sectors covered here has been pretty sharp. Just to clarify, these figures relate to the net balance of respondents expecting either an increase or a fall in values. And so with all of those series turning negative now, it means capital values are anticipated to fall at this global average level across each of these 3 sectors over the near term. And so although expectations have fallen markedly in each case, I think that the reversal is perhaps most striking across the industrial sector, given we had a record high for the series in the not too distant past, and that's showing a very different picture now. And I would still say that of these 3 sectors, industrial or logistics clearly still has the best shape fundamentals in terms of occupier demand and structural tailwinds from online shopping growth. But it seems in some parts of the world, at least, values had just run too far ahead, given the extraordinary increase we've seen since the pandemic, and subsequently become a bit too kind of heated. And now with the increase in interest rates, this seems to have triggered a downward readjustment in valuation levels. But all of this just really acts to illustrate how sudden and sharp the shift has been following what was a very strong early part of 2022. The picture in many ways has kind of turned on its head. So it's clear the investment market has been more immediately affected by higher interest rates. It's caused this readjustment, or you could say repricing of the market, given the rise in bond yields, and that's widely expected to continue through the course of this year, although I think any further falls are likely to be more concentrated in the first half of the year. Now, the extent to which values continue to retreat is, of course, very uncertain. We have already seen quite an adjustment in the UK market when looking at valuation indices, but I think even beyond this, it does seem that we're set to see a further pullback in values to some degree through the first half of this year, at least. Of course, the magnitude will, as I say, vary depending on which sector, which part of the world you're looking at. Perhaps the panelists will have some views on this, but simply from a headline perspective, for many markets, our forward-looking indicators from the survey tell us that the capital values are expected to remain under pressure for a while longer, and the outlook for investment market activity in general, on account of the higher interest rate environment, I would say, is relatively subdued for the year ahead. And then one last thing I would add is that although we're not talking about a hugely buoyant outlook or anything like that, trends up until now have been somewhat more resilient on the occupier side of the market. Okay, momentum is clearly being lost to some extent, but rental growth prospects have not turned in the same way as those for capital values. So that is the case for now, at least. So initially, this adjustment is really evident across the investment market specifically. So those are kind of the key points I'd wish to make regarding the outlook. So thank you very much for your attention, and I'll pass you back over to Simon now.
Okay, thank you very much for that, Tarrant, and some food for thought there, and certainly will help to stimulate some of the discussion. Before we start, I just want to remind you that anyone listening in, this isn't really an interactive session. We do want your questions to be submitted. Please use the function as it is and get those questions in. We're going to be around for another half an hour or so, and we'd really like to have a dialogue with you who are listening in today. So please do take advantage of the opportunity to put a question to our panelists. And also, just one other thing, we are going to run a poll during the course of the next half an hour. We want to get your thoughts as to what is going to happen to real estate investment volumes in 2023. And I think that is going to be that poll is going to be on your screen. You'll be able to take advantage of responding to it. We want to know whether you think it's going to be stronger or weaker than last year, and the extent to which you think that might be the case. So we look forward to hearing your thoughts, both through the poll, but also through any questions. But let me now start with the conversation. And I'm going to turn to Megan first. We heard Tarrant there give us a bit of a macro view on how, slightly downbeat, implications for commercial real estate. I just wonder how, when you're having your discussions with, your own business, I mean, what's the sort of macro perspective that's coming through?
Thanks, Simon. That was a great presentation by Tarrant. I really enjoyed hearing the views. And I think he's exactly right when he says it's a highly uncertain environment, and just trying to approach it with some logic and some sensible responses is the way to go. We have high uncertainty, both actually on continuing post-COVID. It was always going to be difficult. China still slow in opening up, and Louise, based in Asia Pacific, I'm sure we'll talk to this in a moment. So China very slow to open up. So COVID still affecting parts of the world. As we opened up, we had goods and services in the wrong places. So we were always going to have some level of inflation coming through. And then in February 22, the illegal invasion of Ukraine by Russia, leading to dislocation in the energy markets as well. So people have termed this as a polycrisis. So, a difficult set of circumstances. But as Tarrant also said, surprisingly, there are pockets of resilience. He referred to it in terms of the office market. So look, the way we think about it is global growth probably about 1.4% next year, taken as an average across the year, so growth globally. But that's about half the usual global growth number, which from 2010 to 2019 is about 3.1%. So it is going to feel difficult. Allianz Real Estate is now tied up with PIMCO, which has got a large bond fund. And so we've got the benefit of the PIMCO economists. And their view is that the recession will be modest. That's the word that they've used. They've used the word, it's a modest recession, sort of slightly shorter and shallower, based on things like labour markets still being tight and pockets of resilience in the economy. So to echo some of Tarrant's views, what we think that means for real estate markets is relative resilience on the demand side. I mean, obviously there are pockets which are doing better than others. We think that there'll be, growing cities will still have resilience in those areas. But absolutely, the spike in interest rates has caused a dislocation in the capital markets. Cost of debt now sits above net initial yield in many real estate markets, and that's seen a drying up of transaction volumes off globally 30% in the third quarter. So I'll stop there with the opening comments and pass back to you.
Thank you very much, Megan. And Louise, I mean, obviously, there's, we mentioned China, but, there's a lot of different things going on across Asia Pacific region. And I wonder, probably more divergent macro trends there than in many other parts of the world. I wonder whether you've got any thoughts on how it's all going to unfold in terms of the macro background.
Yeah, no, and I agree with Tarrant and his sort of observation that obviously the central bank sort of lifted rates more aggressively and earlier than probably anticipated. And I don't think it's the end of it. The only market that's really bucked that trend is Japan. So the BOJ today maintained its policy stance, and so it's not lifting interest rates. So I think that's interesting because, as you said, there's sort of diverging trends that are happening. And when we look at Asia Pacific, I think it's unique in the way we can look at economic cycles here. I do agree broadly that the transactional volumes have dropped globally and here in APAC. You know, we've seen 38% down on transactional volumes across all the markets here, and Hong Kong would be the worst at about 70% down, and that's obviously due to COVID and geopolitical tensions. So that's also obviously had a knock-on effect in terms of pricing discovery, valuation issue that Tarrant sort of touched on as well. But I think, you know, as we see the opening up of some of these markets and as we see the economic growth that is still coming through portions of the more mature markets here, I think we'll eventually restart the wheels. Touching on the point of China, you know, 3% GDP for 2022 is the lowest on record. You know, for some of the other more mature global markets, 3% isn't bad, but for China, that's pretty appalling. And so that knock-on effect for markets like Australia and Japan, Korea, will be evident, and it really is a bellwether perhaps for at least 2023 in those markets. So we've got to see how that knock-on effect happens. The other thing that occurred over the last year was the strengthening US dollar against the local currencies. So that had a significant effect in terms of valuation. And on top of that, we also had the denominator effect. So as we saw bonds and, you know, shares and things like that sort of fall in value, obviously real estate increased in value in these institutional portfolios. So a lot of these institutional investors were overweight real estate. So therefore, they've been pulled back on their real estate allocations, which I think will need to start being allocated again midway through 2023, 24.
Okay, thank you very much, and that's some interesting food for thought there, because you know clearly, you know, this is going to evolve, and there are some elements of the story which aren't quite so downbeat, and it's going to be interesting to see how investors do respond as the year progresses. Alexandra, in terms of the UK and the macro, we've had inflation out this morning and it's down a bit. So I suppose if you're looking for a bright spot, perhaps that's one. I don't know. What do you think?
Yes, well, thank you, Simon, and good morning, everyone. I will touch on the UK, and then maybe I'll just give a couple of positive drivers for real estate general and asset allocation. I mean, since you asked about the UK, I just find UK remarkable. I love Brits. It's always kind of like chin up, jolly good. Let's keep on with it, despite everything we're facing. But last year was quite remarkable because the UK not only had to face everything the other developed economies were facing in terms of the pandemic, war, etc. We also had Brexit and the supply and labour issues that came out of that. Had 3 prime ministers and 4 chancellors kind of thrown at us. So, you know, sounds like a line for a good movie. And we're also kind of a net importer. So in terms of some of the energy prices and the relatively weak sterling, that also impacted inflation. So it's at slightly higher levels than some other economies, and also impacts on the cost of living crisis. So that's all meant that the UK, in terms of forward-looking macroeconomy, is looking slightly softer, I think, than some of the other G7 economies. But saying that, I look at asset flows, and I was looking at Knight Frank's kind of active capital research and some of the data they put out. And the UK, it looks like the UK will be the number 2 recipient of asset flows, capital flows in 2023. As it was number 1 during the global financial crisis. And I think year to date, actually, it's the number 1 recipient. And I think some of the key drivers of that is you mentioned that we've had probably even more of a shakeout in the UK than some other economies so far. And I think that's very much true. We've already seen kind of asset values crash down incredibly fast. And hopefully that will mean for a slightly faster recovery as well when it starts. I think the UK and sterling is still viewed very much as a safe haven. And it's still relatively attractive in terms of evaluation. I know it's obviously come up a lot against the dollar since November, but still relatively attractive if you're a dollar-denominated currency. And I think investors will also very much favour kind of liquidity and quality assets this year. And the UK, particularly certain cities, are very kind of innovation-led, knowledge-based economies, very liquid, and with some very good ESG profiles as well. So I think the UK is actually in a decent place. On a general note, it was good to see kind of a slightly uplifted look from the IMF at Davos yesterday. I know it's kind of a note of cautious optimism, but it was good to see that. The big things I'm watching are the geopolitical situation and inflation, because my concern is that inflation may be, core levels may stay higher for a little bit longer. These views are entirely personal and my own, by the way. They're not to do with any of the organizations that I'm associated with. And it's great to see the data, but I think because the UK started tightening a bit later than the US, we're still a bit behind in the cycle. So still a lot to see. But despite the macroeconomy and where it is, I think real estate's in a great position. I'm trying to put the positive note to balance things out here. I see a lot of capital waiting on the sidelines. So when the recovery does happen, I think it could be punchy and quite good fun. From an asset allocation standpoint, real estate is still relatively attractive. It's a great diversifier. It should deliver relatively attractive risk-adjusted returns this year. It's seen as a hedge against inflation, particularly some of the income-producing assets. And the old era of asset allocation models is being questioned, and there might be more of a role of real estate going forwards. We're in a very different situation to the GFC. Banks are well-capitalized and well-regulated. And we are seeing debt certainly kind of widely available for good quality assets. And there's some great long-term megatrends and structural drivers for real estate. So that's a positive angle.
Well, you certainly cheered me up, and I assume you've cheered many of our listeners up. Can I remind everyone, of course, that we do want to get your questions, and we will get through as many of them as we can over the next 20 odd minutes. So do submit them, and some of you might not have quite such positive views as Alexandra has, so we do want to hear those as well. But look, let me move on to the next question that I have here. And I really want to get, I mean, we've heard a bit about real estate and being, perhaps, and from Alexandra, it being, a relatively attractive asset class. What I really want to do is dig a bit deeper around whether there are sort of geographies, countries, sectors that are worth highlighting as being relatively attractive over the next 12, perhaps 18 months, perhaps a bit longer, and those that would be worth steering clear of. And Louise, do you want to have a first crack at this question?
Yeah, sure. Look, in terms of traditional sectors, we are looking at Singapore office as being compelling, and we're penciling in probably about 18% rental growth over the next 5 years. We've already seen 11% rental growth over 2022. And there are a number of reasons for that. During COVID, there has been very limited supply come online. We've also, because of the tight supply and the very regulated environment in which the office sector planning is brought to bear here, it means that the government had capped that supply over that period. And we then saw the knock-on effect of perhaps what was the exodus out of Hong Kong for a number of multinational companies then setting up base in Singapore or growing their teams in Singapore. And then we also perceive that as the Southeast Asian countries around Singapore grow in economic wealth, that Singapore really is a gateway to capture that demographic and economic wealth. So Singapore's enduring story over the longer term also looks positive. And also the other thing that Singapore sort of was able to do was really manage COVID reasonably well. So therefore, it did open up faster than perhaps some of the other countries in this part of the world. Conversely, I think that Japan or Tokyo office, we're not so keen on, being very traditional, institutional sort of market. However, I think where we've seen very high supply, we've got 11% or equivalent of 11% coming online in the A-grade office market this year. We're seeing also only pre-commit levels about 30% at the moment, which is unusually low for that market. And we're seeing incentive levels about 30% kicking in, which is also really, really unusual. So for us, we're probably steering clear of that office market. If we look very quickly at like sort of alternative sectors, which are, you know, gaining a lot of interest from investors at the moment, we particularly like senior living in Japan. Again, it is about long-term trends. So resilience through cycles. Japan is the first super age population in the world. About 29% of the population is above 65. And with that aging population, they now want to maintain lifestyles in these sort of key cities. So I think the reason why it hasn't been institutional to date, but we think it is attractive, you know, for this market, is it's been very fragmented, reasonably hard to work with operators because of the small size of these assets and the operations. Financing hasn't been readily available, and people have sort of been happy to look at living from a multifamily perspective as opposed to perhaps senior living. So, you know, I think as it becomes institutional, as you can get longer term master leases and you can create critical mass, that is particularly a geographic and asset sort of trend that we're pretty comfortable and have high conviction on at the moment. So I'll probably stop there. We've got to, you know, we can draw out all these different countries and different sectors in my part of the world, but they're probably the highlight of what we're looking at the moment.
Okay, so some office, you know, certainly you highlight Singapore there, senior living, and I think that may be a more general one. Alexandra, I mean, what do you think in terms of your perspective on the opportunities and the sectors and the you know, whether it's, you know, in countries that you might favour at the present time?
Yeah, sure. I'll maybe put some data out there in terms of what we're seeing, and then I'll give you my personal views. So, I mean, I mentioned the Knight Frank Active Capital report, and I think the top kind of geographical picks in terms of expected asset flows on the commercial side for 2023 are the US, obvious reasons, including safe haven, the UK, Germany, Australia, and France. And this is from a poll from many investors and asset owners, with the sources of capital being the US, Canada, Singapore, Germany, and UK. And in terms of the key sector targets for 2023, they're seeing living sectors, office, logistics, life sciences, retail, and student accommodation as the top areas for inflows. But I think within that, it's very important to say, I think we're seeing a polarization in terms of demand, with the demand very much for the more quality assets, quality in terms of location, as I mentioned before, and also good sustainability credentials, and also a preference for more liquid assets and locations. And probably a focus on good income generating assets this year, given the uncertainty on some of the capital values. In terms of my personal view, I think Singapore, obviously, as you know, as you said, Louise, is a fascinating place with great dynamics. London, New York, and Paris, I think, would be some of my top picks. Paris, because of the huge amount of infrastructure work and everything that will come with that. I think we're going to talk about residential later, so maybe I'll cover off on that separately. But personally, as you said, I like to look a little bit longer term, and coming back to some of these mega trends and structural shifts. One of my top picks would be green investment opportunities. I noticed there's been quite a lot of rhetoric on that at Davos as well. So renewable energy infrastructure, brown to green opportunities, and sustainable lifestyle kind of opportunities. And alternative asset classes, as you mentioned, driven by some of these big demographic shifts, technology revolution, and sustainable lifestyle. So student accommodation, affordable housing, living sectors, healthcare, data centers, and life sciences, certainly in the UK, in that kind of golden triangle, as they call it. I think REITs are a great opportunity in the UK because some of them are trading at such big discounts. So the ones which have long-term debt secured, you're seeing some implied yields of about 6 to 7% potentially on those. Sectors I would keep well clear of. I think some of the sectors more reliant on discretionary spend, given we've got some softer growth, will take some more time to shake out. Some of the lower quality assets, and where maybe some of the more higher indebted assets, given we're still looking at where interest rates will peak at and when they'll come down.
Okay, that's a pretty good summary. Thank you very much. And as Megan, I mean, where do you stand? And we've obviously had quite a range of views already. Where are you positioned?
So just a short answer on this one. I think it depends where you can get debt. So assuming most investors still want to use debt in their financing to buy, the question is, where can you get debt? So in which locations is debt above or below net initial yield, and where are banks willing to lend? Where is there liquidity in the market? So at the moment in the US, markets are pretty dried up at the moment in terms of debt availability for sort of development finance and more risky developments. So I would think that mostly core would be somewhere to look at in terms of development. But there is also a large area where people need to refinance as we move forward, where the financing that they've got on their projects or on their holdings comes to an end and people need to refinance. So there are quite a lot of investors looking at debt financing, where historically they might have looked at equity financing to go out and buy assets. Maybe at this point they're looking at debt financing because cost of debt is sitting higher. And so that provides some opportunities. In terms of kind of the sectors and locations, look, if you look at the investor intentions survey, I think the ANREV pre and ACREF one is just out. So it's residential. For us, we like US multifamily, and we like Japan residential multifamily, obviously logistics. And so location or sort of tighter locations, which you quite often see in Europe, as opposed to the US where you have larger land holdings. So tighter locations in Europe for logistics. And then office, we love global gateway cities, talent pool cities, as we call them. So, places like Amsterdam, the Nordic cities, London, and then some of the sort of fast growing Southwest US Sunbelt cities. So those sorts of locations.
Okay. Some very interesting comments there. Look, I really want to sort of, I want to come back to residential in a minute, because two of you have mentioned residential already. But before I do that, I think I want to turn to that issue that I think Alexandra probably raised more than anyone else, and that's sustainability. Because one of the issues I wonder is, look, this may well turn out to be a soft landing, but there's clearly a lot more pressure around, and businesses are thinking, before committing funds at the present time, and in a way they weren't perhaps certainly prior to the pandemic, perhaps. I just wonder, to what extent does sustainability get pushed down the pecking order of priorities in this sort of environment? I mean, I'm really interested to hear whether the real estate sector is still as focused, and if not more so, or whether or not it is taking a back step. So, I mean, Alexandra, I mean, you raised ESG in your previous comments. I mean, where do you think the real estate sector is, and the wider real estate sector, perhaps, rather than just the top end of it?
Yeah, okay. I mean, I recognize that there are a lot of challenges and the industry needs to transform. But I firmly believe, and everything I've seen, is sustainability has gone from a nice to have to a commercial imperative. I personally, and a number of people have said this, I think it's the opportunity of the century. And we're talking about the macroeconomy. I think this will be and should be a key driver of economic growth and opportunity. So we now have 90%, and I'll get a bit macro here for a moment, but 90% of world GDP signed up to a net zero commitment, if I look at which countries have committed to Paris Agreement. And we have over 1.2 trillion real estate assets who are part of the race to zero, which means they need to halve emissions by 2030 and become net zero by 2050. So I am I am confident and hopeful that this is the year of action. In case you haven't guessed, I'm quite passionate about this area. Alongside this, kind of social factors have very much climbed in priority, along with the need for a just transition. And with COP15 just happening, there's a renewed focus on kind of nature and biodiversity as well. So I kind of wrap all that into one in terms of sustainability. Having said that, COP27 showed that the building environment has hit an all-time in terms of emissions. And since it accounts for 40% of global emissions and 80% of buildings will be here in 2050, I think now is the time to act. I think we all know the big drivers. It's not just that we want to do it. I think regulatory changes are now happening. Disclosure requirements are upon us. In the UK, many now have to do TCFD and transition pathways this year. There's a lot of shareholder and stakeholder pressure on this. Energy prices are necessitating the move to energy efficiency, albeit there's been some backlash on energy security last year. And we have a lot better data and technology, which enables us to kind of value assets better and put a value on physical and transition risk and potentially stranded assets. And I think access to finance will get increasingly different if you're not on a transition path to net zero. And I'm talking a lot, so I'll just give a couple of kind of stats here. I think some of the premiums, ESG premiums that are out there, Knight Frank from a valuation perspective have put a 10% premium on commercial buildings that are BREEAM very good or excellent. I haven't seen one on outstanding, probably because there aren't that many outstanding buildings yet. And this is obviously driven by these buildings being kind of more liquid and financing in a better income stream. On the office rental side, I think it's about a 12% premium on rents for outstanding and a 5% on kind of excellent, a bit lower on very good. There are costs involved, and I recognize that. You mentioned I'm a non-exec at Schroeder Real Estate Investment Trust, and there's one development that Nick Montgomery and the investment team are doing, which will be the first operational net zero warehouse, I think, in the northeast of the UK. And interesting, the additional cost of making that net zero, they estimate to be about 5%. But the return on that subsequently in terms of rental and valuation will be much, much, much higher than that. Last point, so I'm excited about the FCA categorizations coming out on funds. Sustainable focus, sustainable impact, and sustainable improvers. I think sustainable improvers will be particularly relevant for real estate and a fantastic step forward. It's great to see the Mission Zero review. We need to do a lot more in terms of policy and incentives, but that is a big step in terms of positive proposals, which will touch the residential side as well. And it's great to see more standards emerging, including the Green Building Council's Net Zero Whole Life Carbon Roadmap, which is very helpful. So very, very, very strong view on sustainability, I'm afraid, but I do recognize the challenges that go alongside it.
Okay, great. Well, look, I mean, it's certainly really positive message there. I mean, what about across APAC, Louise? I mean, what are you seeing on this issue? Obviously, a very diverse region, so it's probably going to be hard to wrap it all up. But
correct, and there's different certifications depending on what jurisdiction we're talking about as well here. Like, funnily enough, the Australian Property Institute also found that 10% premium for highly rated neighbours buildings. So they must have talked with Knight Frank, perhaps. So they are aligned in that 10% premium. So I think in this part of the world, particularly as we see core real estate and the investment within core real estate, there is an expectation that there is a need for green office buildings. Core means the best specified buildings that get the best tenants to deliver resilient income over market cycles. So therefore, instead of a green premium, I think what you're going to see is perhaps a brown discount for those buildings that don't come up to scratch. They won't be institutionally traded, or there'll be a discount applied to them. So I think for APAC, and this is relevant for global sort of sustainable buildings and ESG, but the drivers that are going to keep it on the agenda for the future to come are obviously social and political pressures and reactions. The paradigm shift in the capital markets, which we've sort of discussed, what is a discount in rent and capital value, and the changing awareness of real estate and market participants, both on an occupier and a tenant sort of side. And, whether you're talking about an occupier or a tenant, these sort of users of real estate can apply what is their global sustainable corporate identity in the use of the real estate. So it becomes increasingly important to how we use real estate and what real estate we use.
Okay, thank you. And Megan, your thoughts?
Well, just to add to what the panel have already said, I mean, at the end of the day, people are more valuable than real estate. So organizations' sort of wages costs and their workforce and their people or residents in housing association properties, people are more valuable than the real estate. Or commercial organizations normally pay about 7% of their rent, whereas their wages costs are more like 50 or 60%. So it's well worth occupiers choosing these higher premium buildings in order to encourage people to come back to the workplace and for health and well-being. I just actually want to add, so we've had Knight Frank, we've had Australia, and I'm going to give a shout out to JLL, John Neal, today in the Times, with his 20% premium for, I think it was Central London office, for BREEAM rating. So well done to everybody in terms of, actively going out there and showing that it's the right thing to do. It's not just the right thing to do because it's the right thing for people, it's the right thing to do commercially and economically. Allianz is part of the Net Zero Asset Owners Alliance, which has got about 10 trillion in terms of assets under AUM. So I think as an industry, we're all going in the right direction.
Excellent. That's really interesting. And I know John, and I know he does some great stuff. Megan, while you're talking, just can you give us, I think this is probably going to be the final question, and I'm going to have to apologise to all the questions that have been submitted that we haven't got round to, but just on the residential sector, because that's always got a lot of interest. And I just want to get each of your views on this. I mean, is the residential sector more vulnerable? Are there opportunities? You sort of signalled that there may be opportunities despite the headwinds.
Yes, look, so residential is a massive category. So you've got owner occupiers, which in many markets is the biggest chunk. Then we've got different forms of rental property, some of which is affordable housing produced by governments. Singapore is probably the best example of this globally with its HDB profile system. So to talk about residential, you do have to get into what country and what style of residential are you talking about? So it's quite hard to generalize. So having said that, I am going to make some generalizations. For institutional investors, US multifamily has sort of a huge run up in transaction volumes in 2021. One of the things that's going to show an overall fall in when MSCI RCA do their transaction volumes at year end, we're going to see a fall, but that's partially because there was a massive spike in US multifamily in Q4 21, absolutely huge. So a lot of investors going into that sector. Japan multifamily, we're heavily invested along with many other people in Japan multifamily. So from an institutional perspective, we can say that. But I think if we're just thinking more widely about residential, we know in many key cities, we're not building enough. And we know that in many key cities, mum and dads and families are struggling with rent and energy costs. So I think it is part of, the role of all of us, including the RICS, to find solutions, funding solutions to help this, which may include increasing density. I mean, one of the things I'm passionate about is actually increasing density in the heart of cities. I think it's good for the environment. I think it allows better public transport. And I think that comes from living in Asia for many years, where we have much, much higher density cities than we see in either Europe or the US. So I think the RICS has got a great role to play in terms of, ensuring that there is housing available for all in these key cities.
Okay, thank you very much for that. Louise, what do you make of it? I mean, you've heard Megan's comments on APAC.
Yeah, I mean, I'll touch on probably two markets because, as you know, we've got quite a few different markets down here. Look, Japan multifamily sector, we are also, huge supporters of that. We've got over 3,000 units in Japan at the moment. We consider it a core asset class, and that's for a number of different reasons. In the key cities within Japan, half of the stock is rental stock. And there is low volatility in terms of occupancy. Even during the GFC, occupancy sat at about 90%. The downside risks there are a lot of mitigants around those, including the traditional lease structure that's in place, and also sticky tenant. Tenants stay, for multiple different years on average. So you don't get the turnover in that tenant. You've also seen sort of economic or structural drivers in terms of people coming into cities, so demographic inflows into Tokyo and Osaka. And although you're seeing overall population decrease, you're actually having an increase in the number of houses. So meaning, more houses, less people living in them, I guess. So there is also that middle class demand because you have to house workers within these cities. And finally, you've got really accretive financing. Coming back to the beginning of our conversation today, Bank of Japan is one of the only central banks that really hasn't moved rates. And so, the spread that you're still able to capture is extremely compelling. Look, I think the other market to touch on that seems to be, headline for quite a while now is build to rent in Australia. Although tailwinds like demographics and cost of living, home affordability should be supportive, I don't think it's considered a core sector yet. And that's because we've got lack of depth in the market, financing, valuation comparables, and also it's nascent due to structuring and tax problems. So I think it will get there. It's just going to take a little bit more time.
Okay, great. Thank you very much. And Alexandra, can you just wrap up on this subject? And I suppose with the UK perspective, and someone did ask this question, the opportunity, we know housing supply is a big issue, not just in the UK, but there is a big issue in the UK. What are the opportunities for sort of conversions, a lot of office space? We didn't get around to the perhaps excess office space. Is there opportunities there, the high street similarly? Is that going to be a source of supply that this challenge in the UK can be finally addressed?
Yeah, that's a very good question. I think probably more focus definitely needs to be put towards that, because when you look at the structural opportunities within retail, it's not necessarily at the moment going that direction. I think that the core UK market, I think there's a lot of shaking out to do, probably. I think transactions will be down. I don't know by how much, 25%, maybe, putting a figure out there, because banks do still stress tests. People are going to have to go get mortgages. Cost of living, affordability is going to be a lot lower. So there's going to be a lot of price testing in the market, probably around spring, which is the big buying season. I think whatever happens, I think prices will rebound the following year. And actually, it could be a good thing to allow some people to get on the property ladder, maybe at the lower ends. I think prices will definitely have a floor, as Megan and Louise have talked about. There is limited supply, and the house builder figures that came out last week, they're reducing their new builds by 25%. So that's not going to help. Unemployment, we think, will stay relatively low, so people will be able to afford their mortgages for the most part. Families have healthy balance sheets. They saved up during the pandemic. 75% of mortgage debt sits with the 50 wealthiest percent in the UK. And as I said before, banks are much better capitalized. Mortgages are much better regulated. The LTV ratios are so much lower than they were during the GFC. They're at 4.25% now. But UK, even though the vast majority on fixed rate mortgages, those are 2, 3, 5-year fixed rate mortgages. So a lot shorter than some of the European economies in the US, which might be 10-year. And I saw a stat that from the first rate change in 22 to the end of 25, 70% of households will need to remortgage. And that will definitely have an impact, even if mortgage rates are somewhere around 4.5%, which is probably the new norm or slightly above. The bright spark in the market, which again isn't great from an ESG perspective, but it just is the luxury and super prime markets globally. I think we're expecting a slight rise of about, Knight Frank, the latest research I saw, expecting about 2% rise in house prices globally on the luxury prime side. The differences will be due to currency shifts, safe havens, and interestingly, the policy and tax regimes. And there's a real dichotomy. So some cities are trying to attract the foreign investors, like Singapore, like Dubai. Dubai might be up 13, 14% this year, I've seen. and others are very much protecting against foreign buyers like Canada, New Zealand, and Australia. So some of those cities may come off a bit. That's very, very brief. I've seen price figures in the UK. I've seen a mixture of down 4% to down 20%, but this is off the back of a rise of 19% since the start of the pandemic.
Yeah, look, thank you very much, Alexandra, for that. And indeed, thank you to all our panelists. Look, we could have carried on this conversation for another hour. There's lots of questions have come in, and indeed, I've got some more questions that I wanted to raise. But before I finish, I mean, we have got the result of the poll, and clearly people are more optimistic out there than certainly than I am. And something like just short of half of respondents actually believe that activity will be slightly stronger or significantly stronger over the next year than in 2022. So there are clearly quite a few optimists out there. You've convinced them with your optimistic, upbeat views. But look, let me on that note, can I thank our three panelists, Megan Walters, Louise Kavanagh, and Alexandra Innes. Can I also thank Tarrant Parsons from my team for his macro presentation at the beginning. And thank you all for, listening in and submitting your questions. This session is now going to be followed by a break of, I think, probably around 20 minutes. And we will return at 3:15 Gulf Standard Time, 11:15 GMT for the session Levelling Up the Future of Local Communities and Place Leadership in partnership with Connected Places Catapult. Thank you.
Thank you very much.